As each new year approaches, tax law becomes one of the most important topics in both personal and business finance. In 2025, that importance is greater than ever. With political shifts, economic uncertainty, and rising national debt, governments across the world are eyeing tax policy not just as a tool for revenue, but as a weapon for restructuring society, funding ambitious programs, and tightening fiscal gaps. Whether you are a salaried employee, a business owner, or an investor, understanding how taxes might change next year and what you should do now can make the difference between growth and frustration. Income tax brackets may shift. One of the first things to watch for in 2026 is a possible adjustment to income tax brackets. Due to inflation, bracket thresholds are regularly reviewed. However, depending on the political climate and budget deficits, those thresholds might not only shift, they might narrow. If progressive tax reform gains traction, high-income earners may find themselves pushed into higher tax brackets, even if their income has not grown significantly in real terms. Now is the time to review your adjusted gross income. Consider strategies such as maxing out retirement contributions, using health savings accounts, and bundling deductions to keep yourself in a lower bracket. If you expect a big bonus, commission, or capital gain, you may want to realize it this year instead of next, before any changes take effect. Capital gains taxes could increase. Capital gains tax reform is on the radar of policymakers. Some proposals are suggesting that long-term capital gains, currently taxed at lower rates than ordinary income, should be treated the same as regular income for high earners. This change could dramatically affect investors, particularly those with appreciated stocks, real estate, or business equity. If you have investments that have grown substantially, it may be wise to evaluate your exposure now. Tax loss harvesting, charitable donations of appreciated assets, and installment sales are tools that can soften the tax blow. In some cases, selling an asset in 2025 instead of waiting could lock in lower capital gains rates. Smart investors are already adjusting their timelines and asset sales strategy in anticipation. Changes to deductions and credits, standard deductions, and itemized deductions could be reshaped next year. There is ongoing discussion around modifying the state and local tax deduction cap, which has been a sore point for high-tax states. If that cap is raised or removed, itemizing could once again become more valuable for many households. In addition, education-related credits, child tax credits, and energy-efficient home improvement credits may be expanded or reduced depending on the budget and legislative focus. If you are planning a home upgrade, education expense, or significant charitable contribution, it may pay off to complete those actions while current tax incentives still apply. Business tax rates and deductions may tighten for small business owners, freelancers, and gig workers. 2025 is a critical planning year. The qualified business income deduction, which currently allows eligible self-employed individuals and small business owners to deduct up to 20% of their income, is scheduled to expire in coming years unless Congress renews it. Any tax reform could accelerate its reduction or elimination. Additionally, depreciation rules for equipment and property, expensing thresholds, and employee-related tax credits might change. Business owners should consider accelerating purchases, reviewing payroll structures, and working with tax professionals to optimize deductions under the current law. If you operate under an LLC, S Corp, or sole proprietorship, now is the time to review your structure. In 2026, entity-specific advantages may shift. A conversion to an S Corp or C Corp, or vice versa, could become more or less favorable depending on where the corporate tax rate lands next year. Retirement contributions and withdrawal rules. Retirement planning is one of the few areas where tax strategy can bring immediate and long-term benefits. In 2025, contribution limits for 401(k) IRAs and HSAs are expected to rise slightly due to inflation indexing. However, there are rumblings about potential limits to high-income earners using Roth conversions, a popular backdoor method for growing tax-free retirement wealth. If you qualify, consider maxing out your Roth IRA or converting traditional IRA assets into Roth accounts this year. The taxes you pay now may be lower than the rates you would face in future retirement. Likewise, business owners with solo 401(k)s or SEP IRAs should consider contributing as much as possible before potential limits shift. There is also growing conversation around taxing large retirement account balances, so pay attention to that if your savings have grown substantially. Estate and inheritance tax thresholds may shrink. Currently, the federal estate tax exemption is historically high, over $13 million per individual. But unless Congress acts, that exemption will fall by half in 2026. That means individuals with large estates, properties, or business assets could face much higher estate taxes in just a year. High net worth individuals should seriously consider making gifts in 2025. The IRS has confirmed that using the current exemption will not be penalized even if thresholds drop later. Gifting assets, creating trusts, and establishing family-limited partnerships are powerful ways to shield wealth and reduce future estate taxes. Do not wait until changes are finalized. The time to act is when the rules still favor you. Gig workers and digital payments will be under the microscope. One of the biggest shifts hitting in 2025 is increased scrutiny of gig workers and those earning through digital platforms. Platforms like Etsy, eBay, Uber, and PayPal are under new reporting rules that require them to send 1099-K forms for transactions exceeding as little as $600. If you earn money online, expect more IRS visibility. This includes side hustles, flipping products, freelance work, and digital product sales. To prepare, begin tracking all income carefully and separate personal from business expenses. Use bookkeeping tools or hire a tax pro familiar with the gig economy. As more platforms tighten reporting, ignoring or hiding income is no longer an option. Proactive planning will keep you compliant and protected. International and crypto tax regulations are tightening. Cryptocurrency tax enforcement is entering a new phase. In 2025, expect the IRS to introduce clearer rules, better tracking, and new requirements for reporting digital asset activity. Exchanges are now required to send forms to the IRS, and decentralized platforms may soon be included under regulatory watch. If you have crypto holdings, staking rewards, NFT income, or international wallets, get your reporting in order now. Make sure your cost basis is clear, consider using crypto-specific tax software, and report every transaction. Penalties for non-compliance are rising, and ignorance is no longer an excuse. For Americans living or investing abroad, the Foreign Account Tax Compliance Act (FATCA) continues to expand. Ensure that all foreign accounts and income are properly reported. Offshore tax havens are under increased surveillance, and failing to disclose accounts could trigger major penalties. Tax enforcement will become more aggressive. Lastly, and perhaps most importantly, tax enforcement is expanding. The IRS has received billions in funding to modernize its systems, hire auditors, and improve data analytics. That means audits will become more frequent, especially for high earners, business owners, and those with complex filings. Prepare by ensuring your documentation is airtight. Keep receipts, logs, bank records, and contracts. Use accounting software. Stay away from aggressive tax shelters or shady deductions. An audit does not have to be scary. If your records are clean, you will be fine. But sloppy or incomplete filings could become very expensive under this new regime. The tax code is not designed to punish. It is designed to influence behavior. Governments reward actions they want more of, like saving for retirement, donating to charity, or investing in renewable energy. If you study the tax code not just to survive it, but to use it, you will start playing a completely different game. Tax changes are not something to fear. They are something to plan for. In 2025, the smartest earners will not be those with the biggest paychecks. They will be those with the best strategies. Whether rates go up or brackets shift, those who prepare now will avoid unnecessary penalties, capture new opportunities, and build lasting financial security. And if this topic helped clarify what lies ahead, the next step is simple. Watch the video that outlines the 7 biggest tax-saving moves you can still make this year. Because being proactive with taxes is not just about avoiding pain, it is about unlocking real wealth.